Good afternoon, Outliers. Apologies for my tardiness. I was having a special live stream over on another channel. But you know what? I'm super stoked to be here with you. And I'm super duper stoked to see what's going on in the market. It is absolutely gangbusters in the other direction, as most people would normally trade. So I'm super glad to be here. Dave is here. Jorn is here. Good afternoon, all. Getting awfully close to shorting. Yeah, that's right. Good afternoon, Donna. Glad you made it. Hey, Randy. Peter is here. The Bears are running the house. Big Bears. Brian says, happy Friday, everybody. Michael, greetings and salutations. He made time to stop cracking necks and cashing checks to join us today. Thank you, Tony Soprano, for coming and joining us. Alex, good to see you. Dave says, yes, it is, Jorn. Okay, so let's jump into this and let's chat about this, right? Now, I sent a message over on the Discord earlier, and I said, I love seeing headlines like this, especially if only they had Outlier. They would have made their money and be out of the market just like we did, right? The S&P 500 falls 1% on Friday, heads for the worst week in a year on tech selling and weak jobs report. Nah, worried about it. Good to see you, Jean-Louis. You know why I'm not worried about it? And I was looking at this earlier today. We made buttloads of money over the last couple of weeks, right? The market did hardly anything. The market literally did hardly anything in this time frame. But you and me and everyone in the trading room made bank. And I'm very proud of that. I hope you are too. Because we started trading on August 19th. We started getting the signals. We started having the master keys show us that it's time to start going long. And we got these signals. And in the span of like 10 days, we had crazy returns. In fact, let me pull up my slides. This was the slides I was just showing earlier in the other live stream. So this is the returns that I had in the last 2 weeks, right? How crazy is that? Win rate 84%, average win 22.6, average loss 4.5%. And this one irritated me, if you remember, because it was 1 penny. It was 1 penny, but it is what it is. And so my portfolio gain was 41% in the span of a couple of weeks. That's how it should be, right? This is how trading should be, where you look at it and you see way more greens than you do reds. And the reds are much smaller than all the greens. This is how trading should be. So I am beyond stoked for how this is going to go. Randy says, I even got out of some long-term positions. Exactly. And Outlier had that sell signal on the SPY. Oh, what day was that? That was just yesterday, right? Give it a moment to log over there. There we go. Wait, I don't know why I went here. I just go to SPY. Yeah, it was just a couple days ago. We had the sell signal on the SPY and then kaput. Goodbye. I saw this earlier today. The SPY was down like nearly 2% at one point. Man. So there's a couple things that I really wanted to dissect here. And the first one is, we got out before the sell signal came on a rule that I learned from my trading mentors, which was if it closes under the 20, get the hell out of the way. Wait to put on new trades until it closes over the 10 EMA again. And everything else sets up, right? That's exactly what we saw here. It's exactly what we saw a couple months ago, right? I got out right as it was about to close and ended up closing over. And then, an 8% sell-off happened. And then here, closed right under the 20. Goodbye. This is a rule you need to share with everyone you've ever met. If the market closes under the 20 period moving average, get out of everything until it settles down, right? I am demanding you share that because a lot of people are freaking out today, freaking out over the last few weeks with this market volatility. And I'm looking at this on the outside, just like you are, with zero stress, negative stress. And then to see it go down like that, it just reinforces the point. Now, why is the 20 so special? It's not magical, but let's examine this, right? This is a cheat sheet that I got from one of my mentors, Steve Burns. Michael says, say that again. Say that again. If it goes under the 20, get out of the way. The 20 EMA is a reversion to the mean after an extended uptrend. So if it closes under the 20, it's now reverting away from the mean after an extended uptrend. If it's under the 10, it's an indicator of the short-term trend, right? And then the 50-day is a key support level. If it breaks the 50, there is no key support level anymore. So let's talk about this. There was a question about why 10, 20, 50. The 10 being a short-term trend, the 20 being an intermediate-term trend, and the 50 being a long-term trend. When you see the 10 go under the 20, which we're not there yet, we're close, but not there yet. We will on Monday, mathematically speaking, unless it comes way up here. When it closes the 10 under the 20, right, that is a confirmation that the short and intermediate term trends have changed. If it closes under the 50, that's an indication of the long-term trend has changed. So that's why we have the 10, 20, 50, not just on the SPY, but on everything. It's the short, intermediate, and long-term trends. If they're all moving in one direction, that's what you want to see. Now, of course, they will change. They will bend. It's not forever. But that's why we use those, okay? Now that's outside the scope of Outlier. Outlier does show you like the trends here. And I don't know the math that goes into these, but having that in your back pocket, just that super, super simple test, 10, 20, 50, or a really easy rule of if it closes under the 20 EMA, to get out of the way until it closes back over the 10 EMA. Just that's going to save you tons of time, tons of effort, tons of frustration on the market and on individual stocks. And in that live stream, I was going over a few examples of trades that we got in and then got out, like Double D right here. In fact, highlighted these on here real quick. Hang on. Double D, 22% gain. XLB, 26% gain, and Scene, a 34% gain. And we nearly hit the top on every one of these, right? It's not just where you get in, but it's more importantly where you get out. And these are the rules that we follow, right? You don't have to, but I would encourage you to. I would say if you're not following these rules, that you're asking for trouble. And it's really cool because we're using the Outlier data, we're using technicals, we're combining everything together to get a holistic perspective on what's going on in the market. And while I'm not going to be shorting anything today, I am absolutely planning on it unless something changes, unless something crazy happens, like we get a move up here, right? Could happen, absolutely could happen. But unless that happens, starting Monday, I'm ready to start shorting, right? If it's anywhere below the 50-day on Monday, that's Shortsville. Put your shorts on, right? Tell Bart Simpson to eat your shorts, because it's time to get ready, right? So be prepping mentally over the weekend. Most people don't understand shorting, so let's go over that real quick. So buying a stock is a lot easier to conceptualize, right? So for example, I'm going to use this DuckTales mug. As you know, Scrooge McDuck is my spirit animal. And so I have, lots of Scrooge McDuck things around me at all times. In fact, I have 2 Funko Pops sitting right here in front of me with Scrooge McDuck, right? It's just my thing. My family knows this. Yeah, just a thing. So imagine I buy this incredible DuckTales mug full of very cold coffee. And I want to hold it until it goes up in value, right? Maybe the DuckTales franchise becomes super popular. And this mug that maybe costs $10 goes up to $20. Well, awesome, right? I would love to sell you this mug, right? It's gone up in value. Here you go. I'll sell this to you for $10 extra. I'll keep the profit. The opposite is true when you're shorting. And this gets a bit complicated. So follow along, ask questions if you have any. Let's say that Michael owns this DuckTales mug. And I'm like, Michael, can I borrow that real quick? He's like, yeah, sure. So I go out and I sell it, right? I go sell it to somebody else for $20 and they give me that $20, right? And then a few weeks goes by and then DuckTales as a value just plummets, right? And then people are like, oh, I don't want this DuckTales mug, but I've already taken $20. I'm like, hey, you know what, dude? I need to give that DuckTales mug back to Michael. So here's the mug. Here's $10. Thank you for letting me borrow it. And now I've got $10 in profit. I can give Michael the mug back and I've got $10 in profit. So it definitely is, it's a different concept, but by trading options, it's hellaciously easier. Tug, glad you're here. When I say it's easier, because buying calls, they go up in value as the price of the stock goes up. Buying puts go up in value as the price of the stock goes down. Y'all have probably heard this story before, but when I was working a day job and I was in the office and some people were having a conversation about Deutsche Bank. And one of them said, hey, if you feel so strongly that Deutsche Bank is going to go down, why don't you go out and buy puts on it? And in fact, let's go to Deutsche Bank, DB. So let's say that I wanted to buy puts on Deutsche Bank because I think it's going to go down. I wouldn't in this case, but let's just say hypothetical, right? I was sitting in the office and I overheard this conversation and I thought back to business school because I got, undergraduate degree in management and MBA in finance. And I was like, puts, man, it's been years since I've heard puts. Let me go research that. And I was one of those nerds that kept all of my textbooks, every single one of them. And I had them all lined up on my desk. And I pull out my finance textbook. In fact, I could probably find it here real quick. In fact, why don't I do that? Why don't I do that? Give me a second here. Pull the green screen down. Wow, behind the curtains like Wizard of Oz. I have all my textbooks down here. This is all my trading books, personal development books, Dan Brown books. I have an autographed Dan Brown book I'm pretty proud of. Anyway, was it this book? No. 3 seconds while I find the book. Here it is, this book. Foundations of Financial Management. There you go. Never mind that man behind the curtain. Foundations of Financial Management. So I pulled this book open, and I always like to tell the story that I sit it on my desk, right? And how many pages is this? Probably 500 pages. 670 pages, right? And I set it on my desk, and I always like to say that the earth shook with the 670 pages that it is. And then when I go and look at the book, there's 2 tabs, and they're still there, right? One says options, and one says bonds. And I put those in there in college, right? This was, I was in college from 2004, got my undergrad in 3 years. So it was 2007 when I got out of undergrad, took a semester off, and then I did my grad school from January to December 2008. Literally worst time ever to graduate, just so you know. I wouldn't do that again. But I turned to this page here, and you can even see my notes. Look at that, College Chris. Put equals sell, call equals buy. It says a put is an option that works just the opposite of a call. The put buyer generally thinks that there is a probability that the underlying stock will fall in price. And in a nutshell, if the price of the stock goes down, the price of the put goes up. So that is literally what started everything for me. That moment, looking up that definition in that particular book. That'll go in the Hall of Fame one day. And most people didn't even know. Like I would say 80% of people don't even know or understand that you can make money as the price of stock goes down. So roundabout way, what I want to get to you is that it could get hot and heavy here real quick. I have made more money on puts than I have on calls. And I've made more money on puts faster than I have on calls. But you've got to be ready for some volatility. Okay. The largest up moves that have ever happened in the stock market all happen in a bear market. So what's great about that is that volatility is going to help the ATR expand. We're about to get real nerdy. The volatility is going to help the ATR expand. So let's go to COVID. I'll show you what I mean. Okay, so this is the COVID crash, right? Everybody remembers that. Stocks went down top to bottom 35% in the span of 23 trading days. That's ugly. But they also went back up 30% in the span of 15 days. Okay, so it went down 35% and then back up 30%. Now you can see 35% down is a lot bigger move than 35% back up, right? But 30% back up in the span of 15 days, 35% down in the span of 23 days. During that time, you're going to see days like this, where from the low of one day to the high of the next day was an 11% move. That's a huge move, okay? But keep in mind, the ATR value, the expansion of volatility, which goes into your position sizing, okay? Your position sizing makes this up. It went from, look down here, it went from around $3 ATR to $15 ATR. So what does that mean? That means that my position size is 1/5 of what it would have been on the way down. Okay. That's why it's so critically important to build in ATR, build in volatility into your into all of your trades. Because if the moves are 5 times bigger, oh man, that's super exciting, right? Oh, I want to trade the same size even though the volatility is 5 times as big. You're setting yourself up for some really exciting days that are both great and not so great, but they're going to be exciting either way. So that's why the last thing I do before I put on a trade is size based on volatility. Because this can go very quickly. Like I say, I've made way more money in puts way faster than I ever did in calls. But keep in mind, the volatility will expand dramatically. So I'm not saying the market's going to crash. But as I have been saying for a little while, totally called it. I always like to point it out that, being market aware is so important. I think it was just yesterday I said, I think the market's ready for a pullback. That's exactly what we're getting. Just be ready, okay? I mean, the ATR is already on the SPY at almost 8. Whereas a few weeks ago, it was half of that. It was at 4. So you're going to have to position size smaller, which is why, I provide this formula for you, or you can go to inside the Discord, the VIP Investors Toolkit, download the power scanner right here. And then you just type in your stock name, right? So SPY. In fact, check this out. This is really cool. This does all the math for you. Well, let's just say if the ATR shows 6 on here versus the ATR showing 15. No, let's do this. 3 versus 15. That's what it was. Okay. Let me zoom in. If we put a 3 on the ATR for SPY, that would be an option size of 41. If we put a 15 on the ATR for SPY, that'd be an option size of 8. So 5x bigger position size when the ATR is small. Now you want that because if you do get into a position where it moves against you, I think we saw it was a 11% move or whatever. Having it 1/5 the size move against you, it's going to be a lot more sustainable, right? This 11% move against you is 5 times as big as it would have been otherwise. That could be it. That could be the end of your account. That could be everything you've ever worked for gone. I don't want that for you. So position sizing correctly is going to be very, very, very crucial, even more than it was previously. So that's going to be it for today. Just y'all get ready. All right. Thank you for letting me vent for a few minutes. This is my passion. This is what I do in life. This is why I was put on earth, is to trade. And now, with Outlier, I can see incredible returns, and I can show you those incredible returns, and you can show your family those incredible returns, and you can show your friends those incredible returns, and they can have those incredible returns. At one point in time, I was holding a contest that I called a wealth ripple effect. And I firmly believe that that's why I put it on earth, is to create the wealth ripple effect. Because the more money I make, the more money you make. And the more money you make, maybe that's enough to send your kid to college, right? Maybe you weren't going to be able to before, but now you can. And now that your kid went to college, maybe they went to medical school. And maybe they went to medical school to be a heart doctor. And then maybe one day I have a heart attack, and your kid, who wasn't going to be able to go to college, who now can, who went to medical school, and is now a heart doctor, saves my life and allows me to stay around longer for my children. That's the wealth ripple effect that I'm talking about, right? And it's not about, saving my life, but it's about what you can do for your family and what that can mean overall. And I'm super stoked about this. This is so cool. So thank you all so much for coming to today's trading room. We didn't cover all that much, but at the same time, we covered a ton. So thank you all for coming. Really, really, really excited about next week. Don't lose too much sleep, but I'll see you right back here on Monday. Have a fantastic weekend. Thanks again so much for being an outlier, and we'll talk soon.